Welcome back, everyone, to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. The world could be undergoing a transformation on par with the Industrial Revolution, thanks to a potential surge in investment in artificial intelligence. Just as NVIDIA's CEO Jensen Huang said, "Why do I care about BlackRock's vision or outlook for the next 12 months? BlackRock owns 90% of the world. If you don't already know, it's the largest asset management company in the world, with $10 trillion in assets under management. BlackRock wants the low carbon transition and rewiring of global supply chains. But the speed, size, and impact of that investment is highly uncertain, and it comes against an unusual economic backdrop post 2020, sticky inflation, higher interest rates, weaker trend growth, and high public debt. BlackRock thinks taking risks by leaning into the transformation and adapting as the outlook changes will be key. 2 years ago, I read their market outlook. They are talking about the investment theme of higher interest rates for longer because they see high inflation persist. However, 2 years ago, there is no AI story yet. There's no rush for people to invest into NVIDIA stock or Palantir stock. In fact, in 2022, those stocks are beginning to bottom. No one wants a piece of Palantir. It was traded at $6 to $7 a share. I was lucky enough to buy some cheap shares back then. Anyways, back to BlackRock. Shocking hard landing scenarios that you are here for. The new regime of greater macro and market volatility has taken hold, shaped supply constraints like shrinking working age populations. The result, higher inflation and interest rates amid weaker growth and elevated public debt. BlackRock sees waves of transformation on the horizon, driven by five mega forces, three of them spurring major capital spending, which in their minds are inflationary. But they designed five shockingly different scenarios to assess the near-term outlook, recognizing it could quickly change. For investors, it means company fundamentals will matter even more. The gap between winners and losers could be wider than ever. This is why companies that lose money could be underperforming in their view. BlackRock thinks the world could be undergoing waves of transformation on a scale rarely seen in history. They use scenarios to help identify where economies and markets may be headed on a 6 to 12-month horizon. BlackRock sees two scenarios where equities can do well. One with concentrated group of winners in AI, even with a tough macro backdrop, and another where AI-driven growth becomes more broad-based, leading to productivity gains and sharp rate cuts. The two hard economic landing scenarios differ on whether central banks can come to the rescue with rate cuts. The fifth is one of the subdued growth and stubborn inflation, where inflation proves sticky, keeping central bank policy rates higher. Will overall bond yields be higher than current market pricing? Are AI valuations headed of fundamentals? If both answers are yes, then we have a high rates, hard landing, sticky inflation rules out rate cuts, and strong demand could trigger further hikes. Growth shows sharply. AI valuations hit hard. This really just depends on how well NVIDIA stock is going to perform in August. If NVIDIA's growth rate slows, that means AI valuation will be ahead of their fundamentals. Then we will get that hard landing, because if there's no rate cuts, long bond price still remains weak. then small and mid caps can't rally. Then we will have concentrated AI driven growth boost not enough to offset other structural drags. Inflation pressure is ongoing and policy rates stay high for longer. BlackRock also revealed this, where subdued growth, stubborn inflation, growth slows to a lower trend pace, inflation is sticky above target, and policy rates stay higher. That's what happened in 2022. I don't think that's where we are going back to, but that's my opinion. There is one good outlook, which if growth structurally better than before 2020, then we will have broad productivity gains, AI, and CapEx boom. AI-driven growth is broad-based, lifting potential output. Inflation is muted and policy rates are cut sharply. If this happens, then both long bond and stocks will do well, but I think that's unlikely. Last scenario, there will be a recession in the next 12 months. Rescued, hard landing, rate hikes overwhelm a broad-based AI-driven growth boost. Inflation falls below target. Central banks deliver deep rate cuts. The transformation could take any of several very different paths. It could lead to a broad productivity boom or to AI winners becoming overvalued. For example, investors may feel tempted to sit on the sidelines and await clarity, especially given the attractive returns from holding cash. Yet BlackRock sees bigger rewards for leaning into risk in this environment. They think markets are likely to keep rewarding perceived AI winners in the next 6 to 12 months, regardless of where the transformation leads longer term. A few winners takes all companies have driven U.S. equity gains this year. BlackRock don't see the concentration of equity performance as a problem, as mega caps have delivered on earnings. Yet they actively choose to lean more heavily into AI than S&P 500 index weights. Two big U.S. tech firms, Apple and Microsoft, each have a market capitalization larger than the entire UK or Germany. Benchmark stock indexes. They say past results don't predict future performance, yet BlackRock has made it clear that their strategy is to focus on the AI winners like Nvidia, as they think because Nvidia stock has gone up 150% this year, it will just keep going higher to the moon. AI's rapid build out now. AI relies on vast computing power, so some large technology firms are racing to invest in data centers to secure that power. We're at the start of this phase. Early winners are already emerging, including those tech firms, chip producers, and firms supplying key inputs like energy, utilities, materials, and real estate. Yet the build-out faces challenges, notably whether the power grid can grow fast enough. Policy and regulation could put the brakes on AI build-out too. For example, policymakers may step in if data center growth pushes up local energy prices, so AI is more inflationary than you think. AI's build-out could initially be inflationary as demand for energy and commodities surge, before benefits expand to other sectors. However, AI reward comes with a lag. On the fiscal policy side, BlackRock thinks large deficits reinforce persistent inflation and higher for longer interest rates. Debt levels for some countries are near or beyond World War II peaks. However, if T-Man gets into office, he is going to drill baby drill. That will increase U.S. oil supply and energy supply. This will make oil prices and energy prices fall. which will make it cheaper for folks to buy food as oil prices go down. Long bond TLT will rise, which will force the Fed to cut rates. As inflation cools, for the food prices to fall, we might face a recession for real, as CPI may fall below 2% yet again, which of course is what most people wanted. But this scenario is not what BlackRock tries to tell us, so that's the difference. They think as more and more fund managers pile in Nvidia, no one on the other side wants to take that profit. But we know stock market doesn't work that way. It's chaotic. Investors will lock in their juicy profits or face the ultimate regret. Because when this thing goes down, it's going to be an epic fall. Is that right, Ted? A lot of fun things? Oh, yeah. Oh, yeah, he says. A lot of fun things. This is a fun spot. Oh, yeah, he's dancing. He's rocking out. He's rocking out. Go, Ted. Go, Ted. Go, Ted. Woo!